Basel II is a set of international banking regulations introduced in 2004. It is designed to strengthen the soundness and stability of the international banking system. The key word here is soundness and stability. We want to ensure that banks are well managed and have sufficient capital to absorb losses. Well, if large banks fail, it can have a ripple effect on the entire economy, as seen in the 2008 financial crisis. The Basel Committee on Banking Supervision, made up of regulators from around the world, developed Basel II framework to prevent another crisis like that. Basel II covers three types of risk: credit risk, market risk, and operational risk. Credit risk is the risk that the borrower will default on their loan. Market risk is the risk that the value of a bank's asset will decrease due to market movements. Operational risk is the risk of losses from events such as fraud, IT failure, or natural disaster. Basel II requires banks to hold a certain amount of capital for each type of risk. The amount of capital required depends on the level of risk that the bank is exposed to. For example, a bank that lends money to high-risk borrowers will need to hold more capital than a bank that lends money to low-risk borrowers. Basel II is based on three pillars. Pillar 1, the minimum capital requirements. This is the most important pillar of the Basel II. It requires banks to hold a certain amount of capital for each type of risk. Pillar 2, the supervisory review. This pillar requires regulators to review banks' capital adequacy and to take action if they are not adequately capitalized. Pillar 3, the market discipline. This pillar encourages market participants to assess the capital adequacy of banks. This is done through disclosure requirements that require banks to publish information about their capital levels. Basel II is important because it helps to protect financial system from risk. By requiring banks to hold more capital, Basel II makes it less likely that a bank will fail. This is important because if a bank fails, it can have a ripple effect on the entire economy. The 2008 financial crisis is a good example of this. Basel II is not a perfect system, but it is a step in the right direction. It has helped to strengthen the soundness and stability of the international banking system.